Hey guys, welcome back. Look, I'm going to be completely transparent. This video was originally intended to be about Broadcom, their quarterly earnings, the impact of those earnings on the connectivity wall and all the associated players. But the wires lit up this morning, and they lit up with so many stories related to the memory sector that it would be a disservice to the community if I didn't focus this video on the memory sector overall, on the memory wall overall, because there was too many undeniable signals that hit the tape today that was related to the memory wall that I had to pivot this video. For months, we have discussed the structural reality that memory would choke the AI trade. Today, that's exactly the reality that played out or took over the institutional tape. The broader market struggled today overall. We saw our indexes all down, but the smartest money in the room, it just triggered a massive high volume rotation directly into the physical infrastructure gatekeepers. The premium is no longer being priced into future promises. It is being paid out right now on the trading floor. Today, we're not going to argue anymore, or the argument is over about whether the memory wall exists. Today, we're going to talk about the direct casualties of memory and what we're seeing in the market, the pricing leverage, the squeeze in the market, and how that's creating a chipflation, and how those challenges and how that chipflation is actually reaching the halls of the U.S. Treasury and Commerce building today. We're going to also talk about the massive data center construction backlog that is threatening to disrupt the entire AI demand cycle. And I'm going to share with you finally a few huge stories that came out of Computex today that are bullish signs for the memory sector. They're bullish signs for the trillion-dollar cartel. Of course, that's Samsung, SK Hynix, and Micron overall. And then finally, I'm going to give you my recommendations on how to manage the risk in our portfolios with all the massive parabolic moves that we've seen with these memory titans, that we've seen with a lot of stocks right now. So make sure you stay to the end and you pick up those recommendations from me. But if you haven't done it already, hit like, hit subscribe to the channel. Guys, we have seen massive growth over the last couple of videos. Thank you. We have passed the 20,000 subscribers. We're continuing to grow. So thank you to each and every one of you for your support, your engagement, for just how you embrace this channel. If you haven't subscribed yet, though, do me a favor, subscribe now. Or better yet, watch the entire video. If you like this content, if you learned something from today's video and you haven't subscribed, give me a subscribe at the end. I bet you will learn a few things because today I'm going to cover a lot of material. And we're going to start off first by just taking a look at how Micron actually traded today. So let me pull up Micron's performance. I'm going to walk through Micron and not SK Hynix. I'm going to walk through Micron and SanDisk, but then I want to get into the stories that hit the tape because I think it just tells a broader story across the impact, we'll say, of the memory products that the memory manufacturers are having across the entire economy overall. But you can see Micron had another strong day. Not as strong as we saw on Monday and Tuesday, but will take green after the massive moves that we saw earlier this week. So it was up $15.50 today, a little over, just under 1.5%. It closed at about $1,080 a share. And if you look to the right, the new 52-week high is almost $1,090 a share from Micron. We're seeing a bit of a pullback right now, 3.5%. So this has come up in the last hour and a half. It was right around 2.5%. We're seeing it actually accelerate another full percentage point. This is a theme we're seeing right now. I do think we'll see some selling pressure tomorrow when the stock opens up. We may start to see some downward pressure and some just some pullback overall. The stock got to a massive amount. Like I said, it hit up about $1,090 a share today. We've broken through that $1,000 psychological ceiling. Inevitably, you are going to see some profit taking. We're heading towards their earnings. We know historically in the last earnings, we saw a massive ramp up, but then a massive sell-off right after the earnings. So it'll be interesting to see what we see on June 24th this week. But the stock has been such a mover. I think we are bound to see a bit of a healthy reset across the board. So make sure you listen to the end. I'm going to give you my advice on how to play that risk in your individual portfolios. But let's jump over and take a look at the candle pattern, because a few things I want to call out for you on Micron here. You can see it actually the bears attempted to push it down today. You can see right in the first hour or so, the stock got down to about 1,038. But then we just saw a massive kind of reversal, a nice step in with support and conviction, institutional support, retail support, probably both across the board. But it drove the stock all the way back up to hit a high of 1,075 here. We saw a little sideways digestion. Volume was pretty suppressed compared to the opening and the close of the day, kind of steady volume across the board, but then a nice ramp up here in the afternoon. So as we headed to the close of the day, we had a nice ramp with Micron across the board, the last few candles were down. That's what we're seeing in the after hours as well, as this continuance of that kind of sell-off as well. I'm going to have to take a look at some stock block trades and see what hit the tape in the dark pools to see if there's any signals we can pick up from there. I didn't have a chance to do it yet, so my apologies. But clearly, you can see it was a strong level of support and conviction and a little bit of sell-off in the last 10 minutes before the closing bell. But what I also like on this here, if you take a look at the RSI below, you can see it's completely neutral. It was actually pretty neutral all through that afternoon selling, all through that conviction level. And it's kind of finished the day a little bit of high neutral, but still neutral nonetheless. The RSI is not showing any signs that this stock is oversold or overexhausted. So we'll see what happens tomorrow, what the selling pressure we'll see on the stock. It's not going to be related to any technical factors or indicators related from an RSI. It could be just the fact that this stock has been on such a run and there's going to be some profit taking overall. But if we thought Micron had a great day, SanDisk defied gravity today. So let's pull them up. They were off almost 7% on the board. They crossed the $1,800 barrier for a stock price, finished with about $115 gain today. You can see at the intraday high, they actually got up to $1,861. So the stock closed pretty close to its new 52-week high. We're seeing a bit of pullback as well. And this has come up too. This is about a little over 3% now. It was in that 2.5 range before too. So we're at about $60 pullback. Stock right now broke back down through that 1,800 level. It's at 1772, 1773. So we've got to keep our eye on that as well. And if I just quickly jump to the right, you can see Western Digital. Western Digital was up $31 today, almost hit the $600 mark. I'm sure if I pulled them up, they went over 600 in their intraday high. We're seeing a pullback there too, a little over 2%, $13. But this stock was a lagger for a while. It definitely didn't lag today. It had a really nice day with a $31 gain. Seagate down below. It's actually was up by about 1.5%, $14. Hit, $940, almost $941 a share at close today. I mean, Seagate is getting close to pushing towards $1,000 a share. I know we've seen some price targets from them are out in the $1,000 share now as well. But we are seeing pullback there too, and that has come up too. It was about a 0.6. Now it's at a 1.3%. So we are seeing this acceleration in kind of selling pressure here in the pre-market overall. But what drove SanDisk today was a price adjustment or kind of price target change. And I'll pull that up for you. It was from Morgan Stanley. Now, it wasn't a massive jump. They went from 1,100 to 1,750. They're already kind of in the negative downside from their price target from where the stock is trading today. But at least it was nice to see that their analyst, Joe Moore, finally admitted that we have a shortage in the market. And he mentioned, you can see in the highlighted paragraph here, there is no quick fix. That supply constraints, they are poised to keep pricing elevated for 2 to 3 years or longer, driven by relentless AI infrastructure demand from the hyperscalers. So that was a sentiment. I think not only did it drive SanDisk today, but it also drove Micron, the entire memory sector overall. But the nice part in that article is Joe did admit that it is DRAM that is driving this pricing power, that DRAM is the principal bottleneck right now in the AI infrastructure build out. Now, they finally admitted to their clients, like I said, that we are locked in a structural memory shortage and there's no quick fix. That supply constraints will keep pricing elevated for 2 to 3 or maybe longer. So Wall Street's models are realizing that despite these massive runs, the stocks are trading significantly low. Their forward PEs are ridiculously low in many cases. Micron's is still like 10, 11. And here's the thing I want you to mark down and fact check me when the earnings come out. I'm guessing that Micron is going to be so bullish with their next quarter and their kind of forward-looking guidance that their forward PE is going to come down even lower. I think we see it get down into probably the 8-9 range overall because of the massive guidance they're going to give, the revenue they're going to have, and how they're going to guide moving forward for the next quarter and ultimately for the next year overall. So when you look at the tape, it clearly shows you a position where institutional demand and conviction right now is absorbing any level of profit taking that may be out there in the market. It's been a very strong week for the sector. It's been a strong number of weeks for the memory titans overall. But there have been some concerns in some articles that have jumped out. And there was one that I want to call out that hit the newswire today. It was from Reuters. I'll pull that up. And it was all related to this concept. We may have talked about it before, but chipflation. And chipflation is this growing concern across the entire economy. You know, what they went on to say is, I think it was JP Morgan. Let me pull it up. Yeah, it was Morgan Stanley. Sorry. that Morgan Stanley went on to say that it is becoming a macroeconomic concern. You can clearly see a few things. That in the second paragraph here, they mentioned that chip prices have spiked sixfold in the past year. That it's driving, and I'll jump back to the first paragraph. You can see that it is driving makers of devices, of smartphones to PCs. They're forced to choose between either raising prices on their consumers like you and I, or settling for thinner margins overall. So not a great choice for those companies either way, either thinner margin or spiking up the prices for their consumers. What also Morgan Stanley went on to say in their 66-page note, if you look right here in this middle paragraph, is that the AI infrastructure bottleneck is now spreading into hardware margins, device affordability, cloud costs, and ultimately inflation and policy. It's having a significant impact across the entire economy. And unlike past boom cycles, the brokerage firm said that the current surge could be a durable supply-demand reset as large cloud and AI companies lock up capacity through long-term agreements and other commitments overall, leaving traditional buyers scrambling for smaller, tighter, or more volatile supply pool. And they even went on to call, one more thing I want to call them, Microsoft, they said in April that $25 billion of their $190 billion in spending this year will come from higher chip prices. So memory producers benefit from stronger prices, margins, and visibility. And downstream hardware companies, and ultimately us as consumers, we must absorb the costs. The hardware companies must absorb them, pass them through to us, or redesign products or risk demand destruction overall. And this concern, like I said, this sentiment, it spilled over to the halls of the U.S. Treasury and Commerce Department today. So you can see that a group that was representing automakers, retailers, and electronic firms, they sent a note to the U.S. Treasury Department. And they called out an urgent imbalance in the market for memory chips, and it could lead to a significant and sustained near-term price hike for American households and disrupt the critical U.S. supply chain. They further went on to say that, because of the consumption by the data centers, an enormous share of available memory chip capacity has resulted in an unprecedented surge in price, and it's reduced the supply of chips for consumer-facing industries. The group added that this real-world impact of these trends have already begun to show themselves and threaten to deteriorate rapidly if the situation is not remedied. The U.S. Commerce and Treasury Department did not respond. But this surge in memory costs, it exposes a dangerous paradox, too, that we see in the market, because the street is assuming that if big tech has the capital to order billions in hardware, that revenue growth is guaranteed. But infinite capital cannot bypass finite physical space. The hardware bottleneck is showing signs and signals that it is stressing the hard physical grid reality. I want to show you an article that came out in Wall Street Journal today. It is another rising level of concern, I would say, for us as memory holders and just in general for the data center build out or the AI infrastructure build out. But you can see the article says that America's data center build out is falling way behind schedule. I want to call out a few of the things here in this article. First off, let me show you the capital expenditures by quarter. You can just take a look at Meta, Microsoft, Google, and Amazon, and just look at the growth rate that we've seen, right? From 2020 all the way up to 2026. We know this. We've talked about it on the channel. We've seen it in every headline this year and probably towards in the fourth quarter of last year, maybe in second half of last year overall. But the piece that I want to call out right here is the stat that JP Morgan called out. And it's in the second to last line here. You see JP Morgan's analysis last month found that more than 60% of data center capacity planned for completion in 2027 isn't even under construction yet. The construction hasn't even started, and another 7% is delayed. So that's 67% of data center construction is either delayed or hasn't started when it's supposed to be finished by 2027. It is a seeming paradox that they said that if hyperscalers can't break ground on many of the projects that they have announced, what difference can hundreds of billions of dollars make? However eager Wall Street may be to supply it. So they can get tons of money, but if they can't get the physical capacity or the ground or break ground because of everything that they're facing, what does it matter the amount of money they get? That's what Wall Street Journal is calling out today. This is a critical warning sign for all of our portfolios. If construction of these facilities continue to fall behind schedule, hyperscalers will physically have nowhere to place hardware that they are ordering. And when they run out of space, those multi-billion-dollar order backlogs for advanced memory modules will suddenly face delays or could have outright cancellations. The architecture of the AI trade has definitely structurally evolved. The alpha belongs to those who understand the data center shell capacity, and it is the ultimate gatekeeper of the semiconductor demand. The irony is really remarkable, though, here. If you just stop and listen, I haven't heard anyone talk about this, and to me, it is remarkable. Think about this. This is the first time in modern semiconductor history that the limiting factor may not be the ability to manufacture chips. It actually may be the ability to physically plug them into the grid. That is a massive ironic statement, and it's something we haven't seen before in the market. But this explains the corporate maneuvers that are hitting the floor at Computex this week. It has turned into an absolute bloodbath. Let me pull you up an article that came out because the SK Hynix chairman, he dropped a massive statement on the floor today that is a huge bullish. There's two bullish signs for the sector, two bullish signs for the trillion-dollar cartel, the companies of SK Hynix, Samsung, and Micron. But first, you can see the headline that Samsung unveils HBM5 to the world for the first time here at Computex. But SK Hynix says it will expand production capacity at full speed. So if I pull that down, and there's Jensen with the chairman of SK Hynix, but they went on to say that they would double, SK Hynix Group said they would double the company's total wafer capacity, production capacity within the next 5 years. What is a great sign that he said, or a great stat in the second paragraph here, while he was on the floor, while they were at their booth at Computex, he said memory bottlenecks are expected to continue until 2030. Added, we are pushing capacity expansion at full speed. This is the first time that the SK Group has publicly stated the concrete goal of doubling total capacity within 5 years. So in terms of DRAM, Samsung right now, they own capacity. They are estimated to have about 700,000 wafers per month. SK Hynix is estimated to have about 500,000 currently. So if they double their capacity, they will overtake Samsung and will move them into first place as the world's largest kind of producer of wafers for DRAM. But Samsung didn't want to be outdone. At the meeting as well, they actually unveiled a mock-up of their HBM5. It's their 8th generation of HBM. First time that they've ever shown this mock-up. And it's becoming the industry's first kind of, after they became the first to produce HBM4 and ship HBM4E, unveiling their HBM5 mock-up, it is seen as a symbolic move to solidify their technological leadership in the next generation HBM market. The cool piece is we talked about the iHBM. We also talked about Micron's technology of handling heat as we move to the next generation because the stacks get higher. For this particular HBM5, they want to go with a stack of 20 high. And so they have a heat path block technology that they introduced as well. And the heat, it ultimately acts as a chimney to transfer the heat and dissipate the heat out. So they're going to stack 20 layers. They're already planning it for HBM4 and HBM5. The cool thing here, too, is all this is going to be used. It's going to be on a base die manufactured at the Samsung foundry in their 2-nanometer process. So this is a big sign for the market. We're moving into the world of HBM5. I feel like we were just in HBM4 talking about it so much. We're already moving ahead into more advanced HBM products, more advanced memory products to help meet the demand in the market. Finally, let's talk about our portfolio execution segment. I mentioned in the beginning, I'm going to give you some risk strategies on how to manage assets that have moved so fast in your portfolio overall. But just know that I'm still tremendously bullish on this sector overall. So these recommendations don't change my sentiment at all. I think the fundamentals are incredibly strong. In fact, we just saw the SK chair. He mentioned that we will see supply constraints, in his opinion, out to 2030 overall. But as a disciplined retail investor, we never let structural bullishness that we've seen turn into tactical blindness. With both Micron and SanDisk sitting at blistering all-time highs and Micron's critical fiscal Q3 earnings print rapidly approaching right around the corner, the risk profile for these assets have structurally shifted. When a stock trades at this valuation, the margin for error narrows down to zero. So here is my recommendation, or the definitive blueprint that you could deploy to manage risk in your portfolio. And I created a slide just to walk through 3 types of examples that you could deploy. So the first one would be the tranche-based trim overall. So this is for when assets just go parabolic, like we've seen with Micron, like we've seen with SanDisk. And say your original weight was 10% in your portfolio, you may look down and see that it's now 20, 25%. It's completely outweighted from what you originally positioned it at. So in that type of position, I actually would recommend that you take action and trim. I would scale out about 20% of your position to bank your initial principal overall. Let the remaining 80% that you see on the graph there, let it ride the macro wave risk-free. Now, if you look in the middle, I'm a big believer in kind of high-tight trailing stops as well. But the problem with stocks like Micron and SanDisk is usually you base these trailing stops on the standard moving average, the 20-day standing moving average. But we have gone so parabolic that those 20-day standard moving averages are so much lower where the stock is trading today. So my recommendation would be here is to implement a hard stop if you want to do it at exactly 5% below the 3-day consolidated floor for these stocks to guard against any type of rug pull, any type of selling pressure that we could see in the market. So if you did that, the hard stop for Micron would be about 985, and the hard stop for SanDisk would be 1660 overall. But I would also recommend that you manually trail these triggers upward at the close of every green session. Now, if we see a bit of an earnings shock with Micron like we did in March, or if, let's say, the data center infrastructure breakdown liquefies the sector, your capital is protected. In fact, it'll be automatically extracted out of the market and be protected for you. So it's something else to consider. And then the last one on the right is just kind of, I just want to enforce the chasing ban. This is all related to RSIs. When you see an RSI that is screaming above 75 and it's showing signs that it's overbought, do not deploy any fresh capital against that asset. Don't have a fear of missing out and rush in at the absolute top of a structural cycle. Let the earnings volatility clear the air first before you deploy any new capital at all into the asset. So those are my 3 strategies that I would recommend to you. Consider them if you think they're a good fit for you. Let me know your thoughts below if you have any other strategies or if you're aligned with those. But the bottom line for today is this: the easy money in the surface level AI hype has been made. The market is aggressively learning that you cannot run software of tomorrow on an unstable infrastructure grid today. Winning this cycle requires looking past the raw GPU counts and understanding the exact physical boundaries that dictate memory capacity, connectivity and networking, cost spikes, and utility power. I'm been tracking these signals each and every day on this channel. Make sure you hit subscribe button now. Join the community. I drop a video like this every single day. But let me know your thoughts below in the comments. Are you taking profits on this memory run? Are you going to take profits in Micron? Or are you riding these infrastructure plays straight through the earnings on June 24th? Let me know what your precise targets are for Micron and SanDisk as well at the end of 2026. I'd love to hear it. But manage your risk. Make sure you block out the noise. You follow the signals in the market. And I look forward to seeing you guys on the next one.